Hello and welcome. Before we start, please make sure to subscribe to our YouTube channel for news and updates. The path of interest rates has been highly uncertain over the past few years due to inflation, economic growth, and the Fed. The 10-year U.S. Treasury yield, for instance, jumped from 3.8% at the end of last year to a high of 4.7% in April, before settling around 4.2% more recently. Higher rates have defied the expectations of investors and economists, creating a challenging environment for the bond market, since rising rates push down bond prices. However, with inflation beginning to improve, many finally expect the Fed to begin cutting rates by the end of the year. What perspective do diversified investors need to stay balanced in the months ahead? Improving inflation is supporting the bond market. Recent economic reports suggest that inflation could finally be improving. Housing costs remain stubbornly high, but removing them from the picture results in core inflation of only 1.9% over the past 12 months. Other data, such as the Producer Price Index, have shown signs of deflation after coming in higher than expected in previous months. These developments, along with new Fed guidance, have pushed rates lower in recent days, supporting bond prices. The Bloomberg U.S. Aggregate Bond Index, a measure of the overall bond market, is now flat on the year after declining as much as 4% in April. Investment-grade and high-yield bonds are now positive on the year as well. This is in sharp contrast to 2022, when bonds fell into a bear market during the historic jump in interest rates, before stabilizing and rebounding in 2023. The yield on the investment-grade bond index, for instance, is hovering around 5.3%, well above the average of 3.7% over the past 15 years. High-yield and mortgage-backed securities are generating 7.9% and 5.1% respectively. It's difficult to overstate the importance of these yield levels. For much of the decade after the 2008 financial crisis, many investors wondered if yields would ever improve as policy rates remained near zero, or even negative in some parts of the world. Those who rely on their portfolios for income were forced to reach for yield, i.e., to take on more risk to generate sufficient income, such as by buying riskier bonds or replacing them with dividend-paying stocks. Today, although price volatility has been elevated, retirees and investors with long-time horizons can finally benefit from the most attractive yields in years. The Fed is still expected to cut rates later this year. While performance numbers are always subject to change, they reflect the possibility of both rate cuts later this year and settling inflation rates. Inflation rates are still higher than the Fed would like, but recent improvements are exactly what policymakers want to see. Higher policy rates, after all, are meant to tighten economic activity, slow spending, and keep inflation in check. At his press conference, Fed Chair Jerome Powell also emphasized that the Fed is sensitive to the two-sided risks of keeping the Fed funds rate higher for longer. The Fed's latest projections call for one rate cut later this year, revised down from 3, with the remaining 2 cuts pushed into next year. While this reflects the Fed's sense of caution, it should also be taken with a grain of salt, since these forecasts are often revised. Timing was partly an issue since the latest positive CPI data were released just hours before the Fed's announcement. Market-based measures still suggest that 2 rate cuts are possible this year, with the first occurring in September or November. Bonds can still provide portfolio balance. If rates do finally ease, the historical role of bonds as portfolio diversifiers could receive a boost. Traditionally, bonds have helped to balance portfolios since they tend to move in the opposite direction of stocks. What does the future hold for the relationship between stocks and bonds? If inflation does improve and the Fed is able to cut rates, then traditional patterns could finally re-emerge. The chart above highlights the historical pattern for bond returns. Inflation scares and monetary tightenings, such as in 1994, 1999, and 2013, can result in poor bond returns. However, once these episodes pass, investors have tended to return to bonds as important sources of yield and portfolio diversification. Although the last 2 years have been challenging for diversified investors, the possibility of more stable rates means that bonds could be increasingly attractive. In the meantime, it's important to stay diversified across asset classes as the Fed nears its first rate cut and the price pressures across the economy continue to subside. The bottom line? Bonds continue to be an important part of any diversified portfolio. While the outlook remains uncertain, improving inflation and the possibility of Fed rate cuts could be positive for the bond market in the months ahead. Thank you for listening. For additional information, please visit mraadvisory.com.